So here's what 15-minute looks like here. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it on the right chart? So this chart, this larger chart here is the 1 minute, and this is the 15-minute time frame. 15, 5, 1 minute. Those are your first three time frames to worry about. Okay, and I shouldn't say worry because it's kind of like gives you a subconscious concern that you need to worry about it. You don't need to worry about it. But the levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. If you're brand new, you don't know how to trade ICT, you don't know how to trade price action, you don't know how to trade period, okay? You don't need any other time frame. Okay, you don't need anything else. You don't need a daily chart. You don't need an hourly chart. You don't need a 31-minute chart. You don't need a 17-minute chart. You don't need a 15-second chart. You don't need anything below a 1 minute chart. You don't need anything else to do what I'm going to teach you. Okay, this is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time, in the US. Everything I mentioned in terms of time, if it's the time that matches New York local time. So set a clock. If you have your smartphone, there's a way that you can pull up world time and put one in there for New York. And you'll always know what time ICT is saying to look for these things to happen because they're never going to not be there. Write that down again, okay? And underline it. This is always absolutely without fail. It's never not going to do it. It's always every single effing day. It's going to do this very thing. It's going to do it. It's going to absolutely do it because there is an algorithm and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. SIBI, BISI, that thing. So once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as a foundation to what you're trying to trade, and you can make all the money you'd ever want. I go in and I'm looking for lunch. I'm looking for the liquidity. I'm looking for reasons why the market will trade to this level, why it could potentially trade to this level, but I don't need it to trade, for instance. This is the draw on liquidity. Draw on liquidity is just a initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean and it does not define the absolute terminus to a price run or the be all end all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely, but it's still an initial idea. So when you're first trying to learn how to read these markets, when you're first trying to determine where the market's likely to go, you have to strip away everything that you're trying to force into reading every single individual candlestick. And if you watch a lot of my videos, or if you have a lot of notes, or you've dabbled in things, chances are you probably already have a pet technique that you want to be yours. And you may not even be good at using it yet, but you just want it because it has a cool name, like a Reaper fair value guy. You know, when I taught that to my private mentorship, they're like, "Oh man, that's gonna be my thing. that's gonna be it for me." You know, or Event Horizon, which is the midpoint between two new week opening gaps or new day opening gaps, and because of the names, okay, these names are meaningful to me. They're not meant to inspire you to want to do them over another. It's just that's what I name them. I got 81 of these things, so it's a way for me to keep track of what its purpose was, and or it kind of puts a little stamp of when I discovered it and something had a impact on me, and it was a cool name or inspiration to it. So when we're looking at price, as a brand new student not knowing what to do, you want to make this kind of like a game and a discovery, something fun, not a video game, okay, but it's a game of determining, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming. It's okay, I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? So in other words, if you had a shark, if you had two sharks rather, you have two sharks in front of you. One has had its teeth removed. Well, that would be represented something like this. This is the shark with no teeth. It's basically got gums. Okay, there's no teeth there. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness, the jaggedness, the jaggedness, and now it's going to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? So you observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, okay? If you're looking at it through the lens of a second chart, sub 1 minute, or a weekly chart or a monthly chart or a quarterly chart where it's 3 months of data compressed in to make the candlesticks, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. It look like to be smooth. When you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade, long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it. And they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter. Listen, folks. It does not matter how many buyers are buying the market to go up there, and how many short sellers. Okay, the proof of it is just look at a depth of market. Look at a ladder. Okay, a dom, not a dome. Okay, I'm so tired of hearing people go. It's not a dome. Do you see an E at the end of that? It's DOM. It's a dom. Okay, depth of market. Look at those orders. There's no imbalances there. There's no imbalances. There's just as many short orders below the market as there is above. But yet the market will still march and march and march and march and go to the beat of the drum that I tell you it does. It reaches to these levels because it's coded to do this. And if you do this for a couple weeks, you're going to see, oh wow, yeah, this feels artificial. It feels like it's designed to do these types of things because it tends to repeat every single day at specific times of the day. It will do this. Now let me go back to the times element. Every day between 8 o'clock in the morning, this is always New York local time, okay? So it's very important you remember that because I have new people coming all the time. And they'll say, I looked at this chart here and you told me, yeah, but you're looking at it in Bangladesh time. Okay. I don't live in Bangladesh. I'm in the East Coast of the United States, and the algorithm is on New York local time. I don't care what anybody else tells you. Okay. That's what it's on. Period. End of story. You can wrestle with it if you want, but that's just the way it is. Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Okay, let me go. We've had the 15-minute on. Let's go down to a 5. Okay. So right away you can see that this high here is relative to that one, and this one here also with that. This one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30, because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 right there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts, that want to see it drop because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Why did I pick this high? Yes, he got my question. Finally, I've been sitting here the whole time you're talking. Why'd you pick that high? What's the first thing I told you? The algorithm is going to go based on time. It's not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. Okay, so you can have a model that says, I can't be in front of the charts between 8 o'clock and 8:30, and maybe you can't even trade a 9:30 opening bell for indices because you have to get ready for work. Okay, but it just so happens that the time elements in your personal life and geographically location in the world, that it allows you and affords you to look at the market between 7 o'clock and say 7:45. Worst case scenario, 7:30. If you're going to work with smaller time frames, you absolutely can use 7 o'clock to 7:30 as a model to do this very exercise. Same thing. So your key times are this: 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. Okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Now, Caleb, you're not expected to do anything else beyond that until I change the depth of what your focus should be. Right now, you're just having 3 charts up. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. And then your second chart could be the 5-minute chart. We'll go back. That's what it is right now, 5-minute chart. But then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for, where is the market smooth? Smooth. Because still waters invite rocks. Think about that. Remember being a kid walking and you see a pond, it's real smooth. Wow, look at that. It looks like a mirror. You can see the sky's reflection off of it. So smooth. What's the first thing that jumped in your head? I need a rock. For what? Because you can't accept that. Our sinful nature says we have to disrupt that. So you pick up a rock and you want to throw it out there. Why? What's it going to do? It's going to cause ripples. That's exactly why a weak character individual in a relationship will have a beautiful relationship, a wonderful relationship, something smooth. Ain't no drama, no reason for ruckus. And what they got to do? They go out there and they chase some thought. They go to the bar, they pick up some floozy or some silver-tongued fox that says all the right things for her. And you invite that disruption. Well, that's what the market does, folks. It's a dysfunctional family environment. And you have to be the one that says, not today, Satan. Not today. Not today. I know your tricks. I know your snares. I know how you're going to do it. Okay? So, what's the market going to do? Every single session in the morning, you have 3 opportunities. And you don't have to trade in the afternoon. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. Okay? If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30. The same thing at 9 to 9:30. Okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. Oh, remember I was telling you I could trade every single hourly candle? Now you're starting to think. The gears are turning, aren't they? Oh, it's fun, isn't it? And obviously the 9 to 9:30, that's your pre-market range, and then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. I don't care what anybody tells you. Okay, it's a 30-minute opening range. That's algorithmic. Okay, so what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30, or 8 o'clock to 8:30, or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line or beginning of that shaded area would delineate the 7 o'clock or the 8 o'clock or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Now, it's not obviously to scale, but I'm oversimplifying for the purpose of teaching what I'm saying. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both, because I heard you, you're thinking it. But what happens if you have a relative equal high here and a relative equal low here? Which one are you going to go for? You wait for the first one to get disrupted, because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Now, gamblers or live streamers that just want to have people watching and doing anything and not really executing on stream, but after the trade starts moving in their favor, then they'll show, oh, I took a trade here. What good is that? What good is that? That just proves you're not confident in what you're doing, and you're going to show it after it's moved in your favor. Talk about it, explain it, and then do it. I'm going to do that. But today I gave you a clinic on how to determine bias, how it's easy for me and it's easy for you. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What's it telling you? What's it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet, and that's why you see all this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. You don't trade into levels where the sharks have already had a frenzy, and that's down here. Okay, they've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it's delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. It's so when you're looking for the bias, okay, the easiest, most scientifically proven, 9 out of 10 doctors approve, ICT has nailed it down to a science of wherever the smooth equal highs are or smooth relative equal lows are at the beginning of 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30. You have 3 opportunities, 3 chances, okay? As each one of these time windows passes by, so at 7 o'clock, we formed the relative equal highs. And then at 8 to 8:30, we didn't go up there yet. So that means that, what, 9 to 9:30, chances are that's the run. See how that does that? It increases the likelihood of it going there. It doesn't diminish it because it's building up more trust in that area right there.